Gold has long been regarded as a safe haven asset, particularly during times of economic uncertainty. This is especially evident during recessions when the price of gold tends to rise while other asset classes like stocks often struggle. Understanding the reasons behind gold's appreciation during economic downturns is crucial for investors looking to safeguard their portfolios. This article will explore the factors that drive gold prices higher in a recession, with a focus on the unique characteristics of gold that make it a preferred investment in turbulent times. One of the primary reasons gold increases in value during a recession is its status as a safe haven asset. Unlike stocks, bonds, or real estate, gold is not directly tied to the performance of any single economy or company. It is a tangible asset that has maintained its value throughout history, even during periods of extreme economic instability. This enduring value is one of the key reasons why investors flock to gold during recessions. When the economy contracts, the value of financial assets like stocks and corporate bonds often declines. Investors, concerned about the potential for further losses, seek refuge in assets that are less vulnerable to economic shocks. Gold, which is perceived as a stable and reliable store of value, becomes a preferred choice. This increased demand drives up the price of gold, hedging against inflation and currency devaluation. During a recession, central banks often respond by implementing monetary policies aimed at stimulating the economy. These policies typically include lowering interest rates and increasing the money supply through measures like quantitative easing. While these actions can help boost economic activity, they also carry the risk of inflation and currency devaluation. Gold is traditionally viewed as a hedge against inflation. When the value of a currency declines, the purchasing power of that currency erodes, leading to higher prices for goods and services. Gold, however, tends to maintain its value in the face of inflation. As a result, investors turn to gold as a way to protect their wealth from the diminishing value of fiat currencies. Moreover, during recessions, confidence in the stability of paper currencies can wane, particularly if central banks are perceived to be overly aggressive in their monetary policies. In such scenarios, gold, which is not subject to the same risks as fiat currencies, becomes more attractive. The increased demand for gold as a hedge against both inflation and currency devaluation contributes to its price appreciation during recessions. Investor sentiment and market psychology. Investor sentiment plays a significant role in the performance of gold during a recession. Economic downturns are often accompanied by heightened uncertainty and fear. This uncertainty can stem from a variety of sources, including rising unemployment, declining corporate earnings, and geopolitical tensions. When investors become uncertain about the future, they tend to adopt a more conservative approach to investing, seeking out assets that are perceived as less risky. Gold benefits from this shift in sentiment. As a tangible asset with a long history of maintaining its value, gold is seen as a reliable investment during times of economic distress. The psychological comfort provided by holding gold can be particularly important when other assets are losing value, leading to increased demand for gold and driving its price higher. Central bank buying. Central banks themselves play a role in driving up the price of gold during recessions. In an effort to diversify their reserves and reduce reliance on fiat currencies, central banks often increase their gold holdings during times of economic uncertainty. This trend has been particularly evident in recent years, with central banks in emerging markets leading the way in gold purchases. When central banks buy gold, they do so in large quantities, which can have a significant impact on the market. These purchases reduce the supply of gold available to other buyers, contributing to higher prices. Additionally, the fact that central banks are accumulating gold can reinforce the perception of gold as a safe haven asset, further boosting demand from private investors. Global economic and political uncertainty. Recessions are often accompanied by global economic and political uncertainty. Whether it's trade wars, geopolitical conflicts, or systemic financial risks, these factors can create a challenging environment for investors. Gold, which is not tied to any specific country or political system, is seen as a neutral asset that can provide protection against a wide range of risks. During times of global instability, the demand for gold often rises as investors seek to protect their portfolios from potential losses. This was evident during the 2008 financial crisis when gold prices surged as the global economy teetered on the brink of collapse. Similarly, during the COVID-19 pandemic, gold reached record highs as investors responded to the unprecedented economic and political uncertainty. Supply and demand dynamics. Finally, the basic principles of supply and demand play a crucial role in the price of gold during a recession. Gold is a finite resource, and its supply is relatively inelastic. Unlike other commodities, which can see significant fluctuations in production based on market conditions, gold mining is a slow and costly process. As a result, the supply of gold does not increase rapidly, even when demand surges. When a recession hits and demand for gold increases, the limited supply of gold means that prices must rise to accommodate the higher demand. This supply-demand imbalance is one of the key reasons why gold prices tend to go up during economic downturns. Conclusion: gold's rise in value during a recession is driven by a combination of factors, including its status as a safe haven asset, its role as a hedge against inflation and currency devaluation, and the influence of investor sentiment and central bank buying. In times of economic uncertainty, gold offers stability and security, making it an attractive investment for those looking to protect their wealth. As the global economy continues to face challenges, the demand for gold is likely to remain strong, particularly during periods of recession. For investors, understanding the dynamics that drive gold prices in these conditions is crucial for making informed decisions and effectively managing risk in their portfolios. Gold remains one of the most reliable assets in times of economic distress, providing a hedge against uncertainty and a store of value that has stood the test of time.